Have you ever paused to consider why a dollar today buys so little compared to a century ago? To truly examine the current state of the global economy, we must first confront a staggering statistical reality. Since 1913, the United States dollar has lost approximately 97% of its purchasing power. While often cited as a critique of central banking, a deeper analysis reveals a far more complex web of causality. Currency devaluation is rarely the result of a single legislative act. Rather, it reflects the cumulative effects of a century defined by unprecedented transformation. During this period, 2 world wars demanded massive government spending and a departure from traditional fiscal constraints, reshaping national economies in ways still felt today. Furthermore, the transition from the gold standard, beginning with emergency measures in 1933 and culminating in the Nixon shock of 1971, fundamentally altered the dollar's relationship with tangible assets, changing the rules of money itself. In this context, the creation of the Federal Reserve in 1913 appears less as a singular act of theft and more as a pivotal shift in economic philosophy. Before its establishment, the American economy was plagued by frequent and devastating banking panics, such as the crisis of 1907, where the absence of a central lender of last resort led to widespread bank runs and systemic collapses. The Federal Reserve was proposed as a solution to provide elasticity to the money supply, allowing it to expand during times of need and contract during periods of overheating. Yet this flexibility carried an inherent trade-off. By prioritizing liquidity and systemic stability, the architects of the new system introduced a mechanism for persistent, low-level inflation. So here's the question I want you to wrestle with. Are we witnessing the unintended consequences of industrial growth and global conflict? Or is this 97% decline an intrinsic feature of a deliberately managed currency? The historical narrative of the Federal Reserve often centers on a clandestine meeting held in November 1910 at the Jekyll Island Club off the coast of Georgia. For 6 days, a small group of influential figures, including Senator Nelson Aldrich, Assistant Secretary of the Treasury A. Piatt Andrew, and representatives from the nation's leading financial houses, gathered in strict privacy. To avoid public scrutiny and market speculation, they traveled under pseudonyms and used private rail cars. While some interpret this secrecy as evidence of a hidden agenda, contemporary historians often note that such private summits were standard practice for high-stakes financial reforms in the early 20th century. The participants were acutely aware that a public debate involving the nation's largest banks would trigger populist backlash, regardless of the plan's technical merits. The document drafted at Jekyll Island, known as the Aldrich Plan, sought to create a central banking system that balanced the needs of Wall Street with the concerns of regional banks. This eventually evolved into the Federal Reserve Act of 1913. The structure they designed was unique, a hybrid entity that combined public oversight with private participation. It consists of a board of governors appointed by the President and confirmed by the Senate, alongside 12 regional Federal Reserve banks that are organized similarly to private corporations. This mixed structure was intended to prevent the government from having total control over the money supply, while also ensuring that private bankers were not the sole arbiters of monetary policy. However, this compromise raises persistent questions about accountability. If the system is neither purely public nor purely private, whom does it ultimately serve? The Jekyll Island meeting remains a subject of intense study, representing the moment when the practicalities of financial engineering met the complexities of democratic governance. A recurring point of interest in the lead-up to the 1913 Act is the sinking of the RMS Titanic in April 1912. Among the casualties were 3 of the world's wealthiest men: John Jacob Astor IV, Isidor Straus, and Benjamin Guggenheim. Some researchers have posited that these individuals were significant hurdles to the creation of a central bank, and their simultaneous passing cleared the political path for the Federal Reserve. However, it is essential to emphasize that there is no documented evidence suggesting a causal link between their opposition and the disaster. In fact, historical records regarding their specific stances on the Federal Reserve are often thin or speculative. While Astor and Guggenheim were known for their conservative business interests, their public record does not show a concerted campaign against the proposed banking reforms. The deaths of these titans are best understood as a historical coincidence that underscores the volatility of the era. The loss of such influential figures certainly shifted the social and economic landscape of New York, but the legislative momentum for a central bank was already well underway, driven by the National Monetary Commission and a broad consensus among the political elite that the pre-1913 system was unsustainable. To focus on the Titanic as a primary driver of the Federal Reserve's success is to overlook the much larger ideological shift occurring in Washington. The coincidence of 1912 serves as a reminder of how unexpected events can shape the historical timeline, but it does not serve as proof of a coordinated effort to silence dissent. Instead, we must look at the broader political currents. A nation weary of financial panics and a government looking for a scientific, centralized way to manage its growing industrial might. The passage of the Federal Reserve Act in late December 1913 is frequently scrutinized for its timing. The final vote took place on December 22nd in the House and December 23rd in the Senate, just as the Christmas holiday began. While it is true that many representatives had already left the Capitol, the session maintained a legal quorum, and the debate had been ongoing for months. The process was formally legitimate, reflecting a hard-fought compromise between the big city bankers and the rural agrarian interests who feared a centralized money power. President Woodrow Wilson signed the act into law on December 23rd, fulfilling a campaign promise to reform the nation's chaotic financial structure. Crucially, the act did not transfer the constitutional power to coin money to private banks in a total sense. Rather, Congress delegated specific operational functions to the Federal Reserve while retaining the ultimate authority to amend or even abolish the system through legislation. This delegation is a common feature of modern governance, where specialized agencies are created to handle complex tasks like aviation safety or environmental regulation. However, the delegation of monetary power is uniquely significant because it touches every aspect of the economy. By establishing the Fed, Congress created an entity with a dual mandate to promote maximum employment and maintain stable prices. In the century since, the effectiveness of this mandate has been the subject of rigorous debate. Did the 1913 Act solve the problem of banking panics, or did it simply replace sudden shocks with a slow, managed decline in currency value? The formal legitimacy of the vote does not settle the question of whether the policy itself was the most beneficial path for the American public in the long term. At the heart of the Federal Reserve System is a mechanism that critics often describe as a debt trap, but which proponents view as the essential engine of a modern economy. In this system, money is created when the Federal Reserve purchases government securities or when commercial banks issue loans. This elastic currency allows the money supply to grow alongside the economy. If the population increases and productivity rises, a fixed money supply such as one strictly tied to gold could lead to deflation, making it harder for businesses to expand and for debtors to pay back what they owe. Thus, the Fed's ability to create money is seen as a vital tool for preventing stagnation. However, a mathematical curiosity arises within this model. When the Fed or a commercial bank creates money through a loan, they create the principal, but they do not create the interest required to satisfy the debt. This suggests that for the system to remain solvent, the total amount of debt must continually grow to provide the liquidity needed for interest payments. This cycle is not necessarily a trap in the sense of a deliberate crime, but rather a functional characteristic of debt-based interest-bearing currency. It creates a powerful incentive for constant economic growth and perpetual inflation. If the growth slows down, the burden of interest can become unsustainable, leading to the very crises the system was designed to prevent. This raises a fundamental analytical question. Is an economy that requires infinite growth to remain stable a sustainable model for a world with finite resources? The loss of 97% of the dollar's value is, in this view, the fuel consumed by the engine of 20th century expansion. As we look back at the 110-year history of the Federal Reserve, we see a record that is neither purely heroic nor purely villainous. The 1913 chain is perhaps better described as a 1913 anchor, a system designed to stabilize a volatile ship, but one that also limits where that ship can go. On one hand, the Fed has successfully navigated the economy through various shocks, providing the liquidity necessary for the United States to become the world's leading economic superpower. The massive industrial output of the mid-20th century and the technological revolution of the 21st were financed through the very mechanisms established on Jekyll Island. Proponents argue that without a central bank, the Great Depression might have been even more catastrophic, and the 2008 financial crisis could have led to a total global collapse. On the other hand, the cost of this stability is the invisible erosion of purchasing power. We have traded the hard autonomy of a commodity-backed currency for the soft security of a managed system. This has resulted in a world where the average citizen must constantly outrun inflation just to maintain their standard of living. We must ask, has the delegation of monetary control created a system that is too insulated from the public it serves? While we vote for governments, the fundamental rules of our economic existence are managed by an independent board that operates outside the traditional political cycle. The 1913 transition was a gamble, a bet that human expertise and managed debt could outperform the natural cycles of the market. Whether that bet has been won remains an open question. The structure built in 1913 is so deeply integrated into our lives that we often perceive its features, inflation, debt, and perpetual growth, as laws of nature rather than choices of policy. The investigation of 1913 is not an investigation into a secret past, but an analysis of the invisible framework that continues to define our future.